Hello everybody and welcome to another one of IRONSHIELD Financial Planning's Fly on the Wall webinars. My name is Scott Plaskett and I'm a certified financial planner and the senior financial planner and CEO of the fee-based financial planning firm IRONSHIELD Financial Planning. If this is your first time tuning into a Fly on the Wall recording, let me quickly explain to you what this is. You're going to experience what it's like to be a fly on the wall during one of my update calls with a member of our Top Guns network. This network is my personal network of specialists. Every so often I ask a member of my network to touch base with me to bring me up to speed on the latest happenings in their area. And when they call me, I record the call so you can be a fly on the wall for that call. In today's episode, I have an update call with Charles Wilton, a portfolio manager at Raymond James Limited, a Canadian subsidiary of Raymond James Financial. Raymond James is one of the most respected investment management firms in North America. I love speaking directly to portfolio managers about their process. Process is so important to investing, and when I can get a portfolio manager to explain their process in plain English, we all benefit from this wisdom. Now, here's the call. Charles, I wanted to take the time today to have a bit of an information session on a little bit about who you are, what your background is, and really more get into the discipline process that you follow in order to, make the decisions you make for making proper investments and making good quality investments. So, maybe we could just start off by, you can give us a bit of a background on, where you've come from, who you are, what your credentials are, just to give people a bit of a perspective on who you are.
Okay, Scott. Well, thanks. Well, I've been in the investment business for around 35 years, and I started off in Toronto with Richardson Securities, and over the years built up the business and built the love for the business. And in 1995, I think, or 1996, Royal Bank bought Richardson's. We were in an independent. And then I stayed with Royal Bank for a few years, and because it was a bank, and because a lot of people were interested in different kinds of products that I was not interested in, I decided to look around and go to another independent. And when I worked for Richardson Securities, it was a family-owned business. George Richardson's owned it, and it had a wonderful feel to it. And I decided, because I knew Raymond James, because I do deal in the U.S. market, I decided to come over, and it's the same kind of business because Tom James is the chairman of the company. And I've been here for the last 12 or 13 years. And I'm a portfolio manager.
So what does it mean? Is that a special credential, or like what makes you different than a stockbroker?
Well, the portfolio manager is a designation that has a higher fiduciary responsibility. Because when I meet with the client and we make an investment policy statement, so we take down in a statement what the goals and objectives are for the client. And because once we have that down, and because I'm a portfolio manager, I have discretion over the account. That means that I don't have to call and talk with the client each time you want to make a change, as an advisor does. For that, there's a higher fiduciary responsibility to meet and to understand more intensely what the goals are, and to align the investments with the goals of the client. And notwithstanding with Raymond James, is that my clients' portfolios are audited every quarter by a different partner to make sure that they're in line with the goals and objectives of every client.
So let me ask you a question then. So you're saying, you're a portfolio manager, which is a higher standard of care. So then, there seem to be thousands and thousands of brokers out there, with Raymond James, which is a very large company. How many portfolio managers are then with Raymond James?
Well, in Canada, we have, I think, around 45.
So for all of Canada,
it's a designation. It's a designation that, depending on the company, they don't give out too loosely for obvious reasons, because of the compliance aspect and because of the discretionary aspect of dealing with the client's money.
Right, but there are a lot of brokers who work through, or basically hold their brokerage license through Raymond James. Is that a fair statement?
Over 5,000.
Okay, so that's what I was looking at, is saying, okay, there's 5,000, around, we're in the thousands of brokers, yet there's only 40 plus portfolio managers. So it really is.
In the U.S., there are about 5,000 or so, or even higher, because we bought a couple of businesses in the States even recently. But suffice it to say, there are a few hundred in Canada, of which about 45 would be portfolio managers.
Right, right, yeah. So it really is a true higher fiduciary standard that you have to maintain over your client accounts. And I like the fact that you've got all the accounts are audited against their policy statements on a quarterly basis.
Yes, there's a very stringent process to go through to become a portfolio manager. That takes over 2 years.
Okay, great. So it's not just it's not just for anybody, is what you're trying to say.
No.
Yeah.
No. In fact, more people get refused than get accepted.
Yeah. Okay, super. Well, I like the sounds of that. So Charles, when you're dealing with, building a portfolio and constructing a portfolio, one of the big questions that people have is how is it that risk is managed, and how is risk monitored? It's one thing that I look for in looking at working with an investment company or portfolio manager or investment counselor. We always want to know what their risk process is, because people can say they manage risk, and people can say that they that risk is sort of one of the things that they pay attention to. But when I go back into 2008 and take a look at a lot of portfolios who had said they manage risk well, it doesn't look to me like risk was being managed at that point. And so we're very, very critical and very, very particular. We pay a lot of close attention to what the risk metrics are that are being managed, so that we can make sure that they're repeatable. So because we know that in the markets, things don't always go up. We do go through ups and we do go through downs, and part of the investing process is risk management. So I thought maybe it'd be a good idea to have you talk a little bit about the risk management methodology and process that you have incorporated into your discipline, and how it does truly protect investors.
Fine. The risk in the marketplace today, it keeps changing, but risk in the marketplace today, as far as I can see, people use the word risk. They say diversification protects you against risk. A lot of people think volatility in the market is equivalent to risk. But when you come right down to it, what risk means is the ability for you to lose permanent capital. So volatility, the stock goes up, the stock goes down, the market goes up, the market goes down. You might be down, then it might be up later. But when I talk about risk, I talk about the permanent loss of capital, and that really is what most clients are interested in.
Yeah. So then, what do you then do in order to manage that risk?
If you look around if you look around to the people that look around in the industry over the last 40 or 50 or 60 years, and you look and you do some research on the people that have been successful in the business, that have made the most money, we call them gurus in the business, whether it would be Buffett or Marx, or there are lots of different people. The best way to protect against risk is what we call margin of safety. And what does margin of safety mean? Margin of safety is simply this. When you invest in a company, not buy the stock or try to speculate, but when we're investing in a company, we're looking at a longer term situation, and we're looking at investing in the business rather than just buying a stock, hoping that's going to go up and we're going to flip it sometime in the future. And the other aspect is, how much are we willing to pay for the business? And this is really the crux of how people are successful in the business. And also, this is the biggest problem that people have. They don't understand the business they're buying, and they don't understand how much they're paying for the business. So when the market is volatile and stocks go down and companies go down, people wind up selling out of fear because they have no idea on what the value is of what they've purchased.
So what you're saying then is, when you know the value of what it is that you purchased, and you know that you purchased it at a price equal to or below its value, which means you bought it on sale, and there is, say, a market correction, you're not saying that the security won't go down in value, but what you are saying is that if it does go down in value, you still have the ability to then identify that the the value of the company maybe is worth more than what the price is currently at if we're in a market correction, which might encourage you to actually buy more of what you would consider a great company at a great price.
To make it more personalized, imagine that you are going to invest in the market. Instead of investing in the market, you're going to go out and you're going to buy a business. And you're going to buy the business, and this is a very important decision on what business that you buy, important enough that your family's future is going to be dependent on the company that you buy. This will trigger a flag and put a lot more import on your research and on your ability to understand what you're doing. So really what we would want to do is we would want to, given that we're investors, is we would like to buy a business that we understood. We'd like to buy a business that is more predictable in terms of growth than not. We would like to buy a business that was number one or number two in its industry. We'd like to buy a business that had a very high competitive advantage. So if it was our business, competitors would be very difficult to come and try and put us out of business. And we would like to have a business that's growing globally so they can send money back to us. So if we understand the business, we understand that it's got a high barrier of entry, we follow the money, they're very good at what they do, low competition, and they're expanding in the world, and we can foresee the future in terms of earnings from a predictability factor based on the past. So once we have that, that's the first starting point to pick the business. That also means that the unpredictable aspect of the business is if we can't buy and we do not want to buy something that we don't understand. We don't understand technology really, even technology people do. So we're in the business of making money. So I don't buy technology stocks because I don't understand how to price them. And I don't buy anything to do with commodities because what's interfering with our ability to grow our business is a third-party commodity. So the price of oil or the price of gold fluctuates all over the world that we have no control over, and it's way too risky to be involved with those kind of businesses, considering the fact that we're trying to have a very high margin of safety and buy a good business that's growing from a predictable point of view. So there are lots of businesses and lots of industries that we cannot get into based on the predictability factor. So once we understand the business and we do enough of the deep dive on that we like, then the hard part is to trying to figure out how much we're going to pay for the business. Because if you overpay for a good business, you've got a problem. And if you underpay for a bad business, you've got another problem. So how do we evaluate a business, value a business? Accounting rules were invented for the debt market, not for investing in businesses. So right off the bat, we have a massive problem by trying to reconcile the GAAP accounting with the economics of the business. So when you go through the balance sheet and you're looking at all the earnings per share and you're looking at all the different conventions of accounting and the GAAP accounting, that does not necessarily have a lot to do with the economics of the business. Here's what I do, here's the money went in and the money came out, and here's my expenditures. So to value the business, you would have to go through 80, 90 pages of footnotes, and you'd have to bring back all the things and scrub all the numbers that are not relevant and ones that are relevant. So there's a lot of things that are off the balance sheet that are very complicated, that are not on the balance sheet, that give you no clue on a realistic basis to value the business. So when some company says they made $10 a share, it's not $10 a share. It's an opinion that's $10 a share. And if you bring other things in, it might be a $10 loss. So this is tantamount to making money and being successful in the investment business. Yes, pick a predictable business that you understand, but you do the deep dive to value the business so you know what you're actually getting. Once you've done that, which is rather complex, and you decide that you're buying, then you look at the market price of the business. So if the business is worth $20 a share and the company's trading at $10 a share, then there's a mismatch. So what is the market saying about the business that they're missing in the business? Consequently, if the company's trading at $50 a share and we think it's worth $20 a share, the expectations are so high, we have a massive problem if we have a correction. So to the point is that if we buy businesses, good businesses, under what the intrinsic value is, then we have a margin of safety. So if we bought a business at 30 and the business was worth 20 and the market corrected, we have a margin of safety there.
So risk basically is managed through your process by really getting a true understanding of what the value of the business really is, and then taking a look at what the market says it's worth. And when you are only allowing yourself, because of your process, to buy businesses for below what you've estimated that they're worth, then that differential, so to speak, is your margin of safety. Is that a good way of putting it?
Yes, the margin of safety is the most important thing. Now, when we buy a business below what the market price is, the intrinsic value is way higher than what the marketplace is. Those numbers are based on very conservative numbers. So it's not an intrinsic value like we add up all the inventory and we look at the book value and we do that kind of thing and say the business is worth $10 a share. The way we value business is on a very conservative cash flow basis. So it's even more conservative than what most people do. So the higher the margin of safety, the less we pay for the assets of a good business, the higher the margin of safety, the safer the investment is. So if the market goes down or when the market goes down, we have the ability and the freedom to be able to add to the position knowing that we're adding way more value instead of destroying value.
So another component of building a good portfolio is the idea of independence. So maybe you can expand on what that means.
Well, most people in the market follow the herd in the research and mutual funds and that type of thing. So most people follow the herd because it's a lot safer following the herd. They don't stand out as much. But from the value basis of trying to make money or building investments and over time, is that we have to not follow the herd. So you have to think more independently, and more independently would mean certainly doing the work in valuing businesses that most people don't value, and some that don't value to the point that we do. So we have to be thinking independently. So we're not in the funds, and we're not where mostly the market is. The other thing is from an independent thinking, I do not care about what goes on in the market. I am not interested in what's going on from a macro point of view. What I'm interested in, and what anyone from an independent point of view is from an investor, a business investor, not an analyst, but a business investor, is what's my business, how much am I paying for the business, and they spend their time on that, independent from trying to decipher all things going on from the macro point of view around the world.
Is that more like the crystal ball gazing type thing that you're
crystal ball gazing?
Yeah.
Yeah, and it's the regression of the mean. Now, what people do is they buy the market goes up and the market goes down. So a company can't keep going up forever for the most part, because it gets over, the expectations get high, then the expectations get low, which create bear markets. So the regression of the means, meaning that if the economy is growing at 6% for the last 100 years, sometimes it's growing at 12%. Well, it can't keep growing at 12%. It's got to come back to 6%. So what are the expectations? So we pay attention not to what the market's doing and not to what overextended companies or highly expected companies are doing. We only spend our time on the value.
Right. And that's done through what you call independence. You're independent thinking. You're not just, as you say, following the herd.
No, we're businessmen buying wonderful businesses. We're not stockbrokers trying to figure out what's happening in the world.
Okay, so when it comes to, deciding what to, include in your portfolio, there's the idea that, in order to make the right decision, it takes a lot of time and effort and what you call preparation. So maybe you can talk a little bit about the preparation side of what goes into that split second, or that one decision of either to buy something or to sell something. A lot of work goes into that. So I was hoping you can expand on that a little bit more.
Well, preparation, when you're looking to prepare, whether you're preparing to trying to be a single-digit golfer, or you're preparing for a triathlon, or you're preparing something, there's a lot of work that goes into that, and a lot of peripheral work that keeps adding up over time. So my preparation, that when I put together my process, the preparation, which is still going on now, involves a lot of things. And the first thing one would look at is, what do you want to do? Find somebody who's doing what you want to do, and then what you do is do what they do. So if you want to find somebody who's very successful and makes a lot of money and a great investor over time, then what you do is you follow them and say, what do you do? So you understand what they do. So from my point of view, I have 50 or 60 people from different areas and different geographies, Warren Buffett certainly being one of them, and a bunch of others, that do what I want to do. So for my preparation, I read all the books. I understand what they do. I follow them. I follow them on the blog. I spend 2 to 3 hours a day, spend an inordinate amount of time preparing to be a good investor. And part of the preparation to being a good investor is to have the process. The process is very important, not the result, but the process is extremely important. So how do we put the process together, and how do we know that the process works? We do it by understanding the model and understanding how other people operate. So it's not the result that we're interested in, is what we're doing. We're interested in more the day-to-day work that we need to be a lot more efficient at what we do. So I'm always looking at different businesses, but I'm always looking at different ways to try and calculate business, to understand how business actually works, to get some kind of an edge, to get some kind of base that creates wisdom that allows my clients to not have to see what goes on behind the scenes, but they know they have a high margin of safety and they're very comfortable.
So basically then on the preparation side, it's the preparation and the process you use in order to properly analyze things. The how do I put it? The result comes from the process. Yes.
How do you prepare? What you're doing is, whatever you're doing now, the preparation it's come from your whole life.
Right.
So, but in my particular case, okay, what's a good business, and how could I buy a business, or what kind of business do I have to buy that I can have the odds of success on my side? How can I start eliminating different aspects of risk, so I can eliminate that, so I have the probability factors are way in my favor of being successful. And one certainly would be a good business, and then a business that has some kind of predictability factor to it. Okay, get rid of that because that's too risky. So identifying those elements over time.
Okay, so one of the big challenges when it comes to building a portfolio is being honest with yourself. And so a topic you've brought up, which is intellectual humility. Maybe you could expand on what intellectual humility is a little bit.
Well, in this industry, it's a bit more important, and it's also a little more problematic, because what happens is, because you're investing and because the market's volatile and the market's going up and down, lots of people think that because the bull market's moving and you're making a lot of money, that this somehow is more to do with your intellectual capacity, which might border on hubris, because now you know what you're doing. You have figured it out, and this is going to go on forever. And unfortunately, most people have seen the other side of that, whether it would be the oil market collapsing, whether it be the tech bubble in 2000 that collapsing. So from an intellectual point of view, it's always knowing that the more you know, the more you understand you don't know. That makes sense.
So it's being, there's a humility that goes with it being, how do I put it? Checking your ego at the door and always recognizing that.
Exactly. So with my process, what I'm trying to do within the process to incorporate these principles and to look at them on an ongoing basis and to read them, and I keep them at my house and I'm reading them all the time just to check in and say, okay, so even though my portfolio has gone up and even though the portfolio is in the top quartile, then I start looking at it, okay, well, what can go wrong here?
Right.
And am I starting to move off? Am I starting to get emotionally disconnected to the point that maybe I think I know way more than I do? So stick with your circle of competence. So a lot of mutual funds operate this way. They're supposed to be value. What they do is to bump up the end of the quarter, whatever. They'll go and buy a bunch of gold stocks or something to try and get a little kick to make sure that people think they're not as bad as they are. So intellectual humility is extremely important,
right? Because
you're the one that can be swayed by yourself easier than anyone else.
So Charles, then when it comes to the actual, condensed steps, so to speak, that you would always follow, I mean, there's got to be a certain rigor to the process. There's got to be a certain unwavering adherence to the process. Maybe you can speak a little bit to the fact that there is such an unwavering adherence to what it is that you do.
Well, from an analytical point of view, and one wants to be as efficient as possible, it comes down basically to what we've been talking about before. It's like, what company do we buy? Why are we buying the company? Why are we making this investment? Well, we're making the investment because we are convinced that we understand the business and we understand the company, and we are convinced that we've done the deep dive in terms of the valuation to the point that it meets a very strict criterion. Now, the criterion, because of the predictability and because of that, is quite extensive. Then what we want to do is I want to try and blow the business up. What would happen? How could I bankrupt the company? So if I'm so sure that this is a good business, what would I have to do? What would have to happen for the company to go bankrupt? So you want to look at both. You want to take on the buy side and the short side. So you should be able to convince yourself and be able to do the work that, okay, yes, I love this business. It's fantastic. It's really great. Okay, what would we have to do? How could the company go bankrupt? And then you start coming up with ideas. Okay, well, what would be the methodology for them to go bankrupt? As Charlie Munger puts it, always invert. So we look at the business, then we take a look at the result of the business, and we go backwards. Okay, what could happen? What did I miss? What about the union problems? Okay, are there union problems, or what if the union had this? What would have to happen for this business to falter? Who would be the new competitor that would come in within 8 months or 9 months from now? Who could take over the business? How much money would they have to put up? Where's the competitor's advantage? What are the competitors doing? Are the competitors losing? The competitors winning? You're in the soup. And the other thing is, you don't want to be a security analyst just by going through the textbook. You want to be business analyst as if you own the business. Once you put yourself in the position as a business owner, you see things that you wouldn't normally see. So how does the actual business operate? What we're doing is these principles are all adding up to the point that act as markers for me to initiate and keep the process intact, or whether we have to keep moving the process over a little bit because of whatever particular reason. But there's a real continuity. And these principles are not just for investing either.
Okay, so when it comes to, allocating the money that you have within a portfolio, there's a lot of people have many different ways of putting their allocations together, and maybe you can speak a little bit toward, your approach to allocation.
Well, for the most part, people, from a capital allocation point of view, most people have fixed income and equity. So we'll just talk about the balance rather than obvious. They just have fixed income or they just have equities. So the balanced approach would be, so for example, 60%, 60-40. So that's fairly common. 60% equity, 40% fixed income. Now, what's important about that is the fact that you have bands of, say, 15%. So you can go anywhere from 75% equity, 25% fixed income, or the other way. As the market moves up, of course, the equity percentage goes up. If the market went down, obviously it moves the other way. So you have an opportunity to be able to balance the account, sell fixed income, buy more equity, or sell equity and buy more fixed income. So it gives you a range of maneuverability for people that can't keep adding money in all the time just because the market goes down. Well, that'd be great. If the market goes down, add more money, but most people can't do that. Number one. Also, capital allocation means whether you have cash in there or not. Lots of people look at cash as dead money, but cash is an asset for most, well, certainly for any business person, and a value person that understands what's going on in the market. Cash is an asset. You don't get anything on the cash, but what you do is you get opportunity. You get quality opportunity. So I look at cash as an asset as well. The other thing is that always look for something that's a lot more attractive. So we're always looking to take out the better looking sister. So if you analyze the companies that you own and you see an opportunity, but you're not going to add another one, then what you do is you get rid of the one that the least liked and add that. So that's important. And that also speaks to the idea that you don't fall in love with everything that you do just because you picked it. One of the things, successful investing, once you get successful in investing, then now you start believing your own press. So you start falling in love with, okay, this time it's different, or this is what I need to do, or this is what I should do, as if you're the one that's making all the greatest decisions. So you never fall in love with an investment because you're always looking at the investment. How can I blow it up? What's the problem? What happened to it last year? What could happen to it now? So it's an ongoing conversation.
So one of the biggest challenges that I think most investors have is is being patient, is the concept of patience. They for whatever reason they've seen in the movies and they've seen that it seems to be, it's like quick and change. There's lots of action, there's lots of sizzle, and there's lots of sexy movement. Stuff's going on all the time. And in actual fact, the behind the scenes is good quality investors have to have the patience of Job. So maybe you can speak a little bit toward the whole idea of patience.
Patience nowadays is not even a word that you hear about anymore. Even when I talk to my kids, people want everything now. They want returns now. They want to go into China now. They want to go to Europe now. Everybody wants something now. Patience in investing, it's like a business owner. If you do your work diligently and you find a company you love and you get an opportunity to buy it at an extremely good price, that's a huge opportunity, and that doesn't happen all the time. So what you do is you buy it and you put it away as if you're the business owner. Now, you don't forget about it and leave it long term, but you keep monitoring it as long as the expectations are there, as long as they're making money, as long as nothing has changed in the business, you hold on to the business. Because some businesses you hold on, they don't do anything for 2-3 years, and then they double in the next year. So have the courage or the convictions of understanding why you're doing it, and then you sit and you wait, because patience is a lot easier when you understand why you're doing it. The other aspect is trying to trade the market is, from a tax point of view, nobody can time the market. It doesn't work. The other thing is that lots of people, because they don't understand what they're doing, they buy something and now something tweaks their interest a little bit more, or it went down, or the market went down and they're scared, so they're going to change. So that creates the opportunity that allows us to make money. It's not about, people concentrate on the result rather than the process, as we talked before about being prepared. It's the process that allows you, what you do today allows you to defer gain down the road. It's like working out in your 30s and 40s and eating properly and eliminating a lot of stuff because you want to do it right now, and you're building for the future. So you're building, good health, and you're building good weight, and you're building good strength and everything because you're doing today that something will benefit you down the road. Most people don't know what they're doing today, so there is no benefit, and they want everything today, so it eliminates benefit. So the biggest problem I've seen since I've been in the business, people's inability to be able to be patient because they don't understand what they're doing. They're just jumping all over the place. So that's a huge problem. And it also works, the whole industry works against being patient. Their buzzword out there is hold for the long term. People say hold for the long term doesn't work. People go in and they'll buy something and it won't be doing anything. And somebody will say, well, what should we do with it? Oh, we're holding it for the long term. It's a good business. But it's not hold for the long term that patience allows you to do. It's monitoring for the long term. Monitoring what's going on with the business. So if you understand why you bought the business, then it's a lot easier to monitor the success and the progress of the business than just buying an oil stock and hoping that China's going to bid up oil in 5 or 6 years or 7 years. The patience, as in other endeavors in our life, is more important in the investment business. So just because it's not doing what you think it's supposed to do or the market's supposed to do, then you want to change. That's a fallacy.
So now, one of the biggest difficulties I think people have when they try to do it themselves, or they're analyzing their own investments, or they're just trying to make some money with some investments, is their inability to act. Right? Their inability to actually move forward with a decision. And so, I think the idea of decisiveness is so critical to your process that you've sort of brought to the table, that, decisiveness is critically important. So maybe you can expand a little bit more on what you mean by decisiveness and how it plays into your process.
Decisiveness, people can't make a decision, or they do make a decision mostly out of fear. So in my business, because of the loss syndrome, which is twice as worse as the gain syndrome, people buy something and the market's going down. Fear makes them decisive. I would rather sell it now and buy it back later. And even if it goes up now, at least I don't have to worry about it going down. So people make decisions based on fear, not based on any kind of logic or rationality. And most people do that in other areas of their life a lot more than they even do in this business. This is a big problem. You can't make a decision out of fear. You make a decision out of opportunity. How do you know when to make the decision? Because you're prepared. You understand the value of the business, and you understand the business, which means if the market had a 25% correction today, would be fantastic. I could go and buy back Nike and buy back some of the companies I really love that got way overextended. So once you're prepared and you understand what's going on, then you're looking for volatility, whether it be the real estate market or buying a cottage or buying old cars or anything else. What we want to understand what we're doing. We want volatility that allows us to be able to go in and buy bargains and take advantage of opportunities. But they're not prepared, so they sell out of fear. Oh, the market went up. Well, you can make, you never went broke taking a profit. That's all nonsense. Can you imagine if Bill Gates started Microsoft and then he thought the market was too high 5 years later and sold all the stock? So we decide out of fear, and that's really a human nature thing, because fear is more important to us as a human species. So it's no different than the market going down and you selling and saying, "Oh God, I'm glad I'm out," than it is, 10,000 years ago walking on the plains. Mm-hmm. Because you're fearful.
So another challenge I believe that people have when it comes to putting together a portfolio is they almost get into this black box syndrome or black and white mentality where they say, well, this is the way it is, so this is the way it's going to continue to be. And what they're failing to incorporate is the idea of change. And that's something that you've brought brought into your process, which is the ability to manage change. So maybe you can speak a little bit toward your ability to manage change along the way.
Well, what changes more than the marketplace, whether it be advertising or business models or the stock market? When I think of when I started and what's changed in the market, every couple of weeks there's something new. There's DTFs, there's all kinds of different products, and there are people coming to the product to try and create change in the marketplace. And by changing the marketplace, they're selling an opportunity. And they're selling you something that you can be successful now because we're changing the market. It's not the way that it used to be. So things are a lot different now. And one of the big culprits from that was certainly the tax shelter business, where people said, okay, now we're changing the way that it operates. Now we can do the tax. We can write the tax off. We got flow through shares. We got this kind of thing. But many, many people were blown up in the tax shelters because of a massive change in the business. And you also look at the income trusts as well. So when I look at change, I look at my core ability to not take my ball off a good business at a good price. And as I see the market changing around me, I don't change with the market. You might change other things or clothes or golf clubs or something like that, but I don't go with the flow. So whether it's investing in China or whether it's all kinds of new investment ideas, they're just marketing ideas. So how do people change? When it comes down to fundamentals, and this is important, how much do fundamentals really change? How much the fundamentals changed if you bringing up your kids than your parents brought you up? How the fundamentals changed differently than 50 years ago when you actually bought a business? What was important 50 years ago or 100 years when you bought a business? Well, you want to understand the business, you want to buy it at a good price. So, and if you want to be a pro golfer, the fundamentals don't change. You have to hit the ball squarely, and all good golfers do that. If you don't do that, you can't be a good golfer. So the fundamentals stay the same, but the world changes around you. Now, there might be opportunities that change in the market, fundamental opportunities, for example, different ways of doing business that enhance fundamentals of doing business, different kinds of businesses or different infrastructures of businesses that enhance the fundamentals. But most people buy the change because they like the idea that, okay, now it's going to be different this time. How many times have we heard that the market, it's going to be different this time? It's never different. It's never the same, but it's almost the same. The ability for the market to collapse is based on overwrought expectations. Will we get overwrought expectations again? Yes. Do we have it now? Maybe in some of the smaller biotech companies, but we will have it again. And then we will have it again every 10 to 12 years or so. So the fundamentals set you up and give you a roadmap so you don't get caught up in that.
So at the end of the day, a challenge that I believe people have is they get, I don't know, they let the noise kind of take them off the ball, so to speak. They lose what you call their focus. And so, focus becomes a very, very important aspect to building a proper portfolio and investing and making money at investing. So maybe you can speak a little bit about, the importance of focus and what it is you need to remember when it comes to focus and in building proper portfolio's.
Yeah, so this is another part. You see how all these principles sort of fit together and add together and support the idea that we always have a particular process and don't worry about the result. So the principles of running and the principles of are all the same. We care more about the process than we do in the result. And focus is extremely important. How easy is it to become unfocused at what's going on in the market now? When you look at the market, even over the last 5 or 6 or 7 or 8 years, or even since 2000, from what's available in the market to the new products in the market, to how the market's expanded, to how it's expanded globally, to we're doing things now that we've never even heard of before. You've got people calling you. You've got every day in lunch, people are trying to sell you products. You've got all kinds of things going on. You've got many, many people trying to bide for your time. So what do? Is we look and we say, okay, here's my goal, here's my purpose, which is the same as we've talked about before. Here's the goal, here's the purpose, here's what I want to do. Here are the fundamentals. Okay, so do I start moving away from the fundamentals? Well, what if I just add this? Or somebody said, well, can you give me a tip? I mean, even though you don't do this, but if you've got an idea on something, could you give me a tip? As you've been in the business long enough, just give me a little bit of a flyer because it must be something that you might like. And the other aspect that because you're successful, you start believing your own press and you start thinking that you've got something that other people don't have. And other times you might start getting way too deep into the numbers, way too deep into the microcosms of what's going on in the market. You start listening to people that are trying to catch your ear in a different way. So focus is just a way that I call it listening between your thoughts. So when I'm looking at businesses and I'm putting together my portfolios and I'm looking at these things, I like to sit back and look at it as if I'm between thoughts. The area between the thoughts, how quiet is that? And for that, I eliminate 95%. Well, but what I read and who I listen to keeps 95% of the market away from me. I don't read the research. There's lots of stuff that I don't do. I don't want to have a conversation with someone that's not going to contribute to my portfolio from a business point of view. So why would I have a conversation with somebody who's trying to do a new IPO issue on a technology company? I'm not interested in that. I'm interested in having a conversation with Buffett or Marx or somebody that is in my realm. Those are the only conversations. It's like only playing golf with golf teachers when you're learning how to play.
Right.
Very high focus. Very high focus. I'm not playing with my fat cousin who can't hit the ball. When I'm learning, I'm going to play with golf teachers until I get to the point that I really understand what I'm doing. So, yes, it's easy to take your eye off the ball.
Thank you for listening to today's call. If you require further information or have a question relating to today's call, please go to the comments section in the show notes below. Ask your question or make your comment and we'll respond directly online. If you would like to take advantage of a free, no-obligation appointment, please call me at 416-626-6515. Or you can visit us on YouTube by checking out our YouTube channel, youtube.com/IronShieldCFP. Follow me on Twitter. Twitter.com/IronShieldCFP. Like us on Facebook, Facebook.com/IronShieldCFP. Or you can connect with me on LinkedIn.